With everything going on across financial markets, why is the dollar crashing? After all, with monetary difficulties seen worldwide, normally we would expect the dollar to be moving higher. Instead, on Friday, DXY, which is the main index that people use for the dollar, that one sank below 100 for the first time in almost 2 years. Quite naturally, that's unleashed a barrage of comments saying, "This is it for King Dollar." In fact, that's exactly what one top-tier mainstream media outlet reported. Quote, "In times of market panic, investors tend to rush to the safety of the dollar. But when stocks swooned in response to U.S. tariffs, they ran away from it. Investors say it's a sign that the greenback's global standing may be eroding." Yet the same mainstream media outlet only 3 months earlier said the dollar will this year, quote, "tighten its stranglehold over global currency markets with little standing in the way." No wonder people are confused. What's true is that, yes, DXY is down, but that doesn't necessarily mean the dollar is. The truth is, DXY isn't the dollar, and more importantly, what the dollar is doing is not good. But not as a threat to the greenback, rather the consequences for everything that we see around it. The dollar as a whole is behaving just how you would expect, given what's going on all around us right now. People talking about the dollar do so lacking that context, especially the Eurodollar, which is what really matters. They mostly have little idea how it works, thanks in part to what Milton Friedman said in 2006. And most of the time, there's almost always an agenda behind their comments, either political or for some financial reasons. As I've been pointing out in various formats for very nearly 2 decades now, the problem isn't that the dollar's being replaced, it's that it's not being replaced. In fact, the dollar isn't even weak right now, which is consistent with all the chaos unfolding all around. And in the specific places where it might be weak, the reasons why are actually consistent with the dollar's general strength against everywhere else. So there's a lot to clear up here, especially given the stakes everyone is suddenly seeing very clearly. And if you go back 3 months, remember early January, where it came to specifically the euro, people were talking about the euro hitting parity, that it was a done deal. Now we see the euro screeching higher and the dollar screaming lower against it. Everything seems to have changed. But back in early January, when everybody was sure the euro was going to continue to tank, here's what Reuters said about it. The US dollar will tighten its stranglehold over global currency markets with little standing in the way of its remarkable run. And a significant number of foreign exchange forecasters polled by Reuters expected to rise to parity with the euro in 2025. And now today they're saying, is the dollar being rejected by the rest of the world? This is what was reported just a week ago. The dollar, for decades a safe haven, on Thursday, it's a Thursday a little over a week ago, fell about 1.7% in its biggest daily drop since November 2022 after President Donald Trump imposed tariffs on imports at levels not seen since the early 1900s. Stock markets also tanked as tariffs ignited recession worries. So the dollar is supposedly losing its safe haven status simply because DXY was down by a significant amount that week and the week that followed. In fact, the euro increased to over 113 to the dollar on Friday, which is the main reason why DXY is weakening to begin with. But is that actually a representation of what's happening in the dollar system or even the dollar exchange value just as a start? Most often when you see these articles, obviously, you can just tell from the very different characterization just from 3 months apart, how there's little understanding what's happening in the dollar. Back in January, everybody said the euro's going to go to parity, it's tanking. Now all of a sudden the dollar's tanking. Maybe they don't really know what's going on in the dollar world, starting with the fact that nobody talks about the Eurodollar system and what really matters about it. Like I said, the problem isn't the dollar's being replaced, it's that it's not being replaced and all the consequences that go with it, up to and including misunderstanding the signals that we're getting from the dollar exchange value. And it starts with DXY. Everybody uses Dixie, as it's known, as their main representation of the dollar exchange value. When DXY is basically, if not the euro, then certainly the European currencies. Almost 60% of the allocation in DXY is to the euro, with another 13, almost 14% to the Japanese yen. So right there, you're talking about 70% with the euro and the yen. And then you throw in the Swiss franc, which is about 4%. You got 3/4 of the index with 3 currencies that behave, as we'll see, contrary to expectations during these specific periods, in these specific episodes. But just stepping back and looking at the big picture, when the euro was falling earlier this year, late last year and into early 2025, and everybody was convinced it was going to parity, it was basically, the way to think about it is risk differentials, not rate differentials. Interest rates are a reflection of risk, certainly, but risk differentials. The euro is falling, it's tanking, everybody's sure it's going to parity, if not less, because Europe was considered to be the worst case. It was certainly weaker than we thought here in the United States because everybody in the United States were betting on strong and resilient, as Jay Powell said. So Europe bad, US good, euro down, dollar up. Now all of a sudden, here we are in March, those perceptions have changed quite a bit. On the one side, while Europe is not exactly looking great, perceptions about U.S. risks have shifted remarkably by quite a lot. So now it's no longer U.S. good, Europe bad. Now it's Europe not so great, but U.S. suddenly we're revaluing what's going on in the United States. So between the euro and the dollar, not the Eurodollar, but the euro and the dollar exchange value, suddenly the mechanics have shifted in the opposite direction. And the reason is because perceptions about the U.S. economy and the U.S. markets and the U.S. financial system have shifted among certainly financial players. So while you're seeing less dramatic risks in Europe and even some policy support, the big announcement from Berlin for the German economy, in the United States, it's the exact opposite. So Europe has got less dramatically one-sided negatives, whereas the United States is now looking more and more like it's falling off pretty sharply. So the risk differential and expectations have been completely upended, and that's really all the currency exchange value with the euro is really reflecting here in the short run. We see the same thing going back to 2022. The thought was that Europe was going to be destroyed by the energy crisis that erupted in the middle part of 2022. So the euro absolutely tanked against the US dollar. In fact, it got below parity and all the way down to 0.96 to the dollar by September 27th. But then it turned around, not because Europe improved, but because Europe avoided the worst case. So risk perceptions shifted in Europe's favor. At the same time, there was concerns about the U.S. economy as well. But it went from Europe being the absolute worst case, get the hell out of Europe, to, okay, maybe it's not going to be that bad, even if it's not actually good. So the risk perceptions shifted in favor of Europe, at least temporarily, that saw the euro soar from below parity in September 2022 to 1.09 by early February 2023. And you see the same kind of volatility in the worst types of cases. Go back to the original crisis, the original Eurodollar crisis in 2007 and 2008. We got massive volatility during the first two Eurodollar crises in 2008, 2009, and then the second one, which was just as important, 2010 and 2011. I mean, massive volatility in the euro to dollar exchange value because of turmoil in the Eurodollar system. Go back to July 2008. The euro was strengthening the entire time, reaching $1.60 to the euro. But then suddenly it plunged. Through October 2008, it was down to $1.24, only to turn right around over the next year by December 2009, back to $1.51 to the euro all over again. And then June 2010, as the European sovereign debt crisis, which is really Eurodollar number 2, that erupted and saw the euro tank again all the way back to $1.20, only to turn around and move higher through the early part of 2011 with some policy support, some relief that maybe it wasn't the worst case in Europe. So by May of 2011, and when Eurodollar number 2 got started, the euro was back to $1.49 in exchange value, only to plunge all over again by July 2012, back down to $1.21. So through the first two major monetary crises in the Eurodollar system, 2007, 2008, 2009, and then again 2010 and 2011 and into 2012, the euro was all over the place. But while it was all over the place and volatile, it was actually moving slowly but surely lower. And then it would go a lot lower and continue to move lower, not in a straight line over the rest of the decade into the 2020s. So people are making a big deal out of the volatility in the euro that is completely normal for these types of circumstances. And since the euro is the majority of DXY, what the euro does has a heavy influence on the DXY index, even if it's not always representative in the short run for what's happening in the dollar system itself. We look at the yen, that makes it even more complicated because the yen tends to behave contrary to, as you would expect, contrary to what the euro is doing. When we go through periods of dollar distress, the yen has tended to rise, except in those periods where that distress is focused on specifically Japan. So go back to the 1990s, for example. During the Asian not financial crisis in 1997-98, the yen was incredibly weak against the dollar as risk aversion, all the stuff that we're familiar with. And again in 2001, the Japanese banking sector was still in an incredibly weak position after the decade it had just suffered, so the yen got weaker in 2001 as well. But in the middle 2000s, things started to change as the carry trade began to develop. And look at how the yen behaved during the 2008 crisis, Eurodollar number 1, as well as the one that followed it, Eurodollar number 2, that we just talked about. During those first two global crises, the yen absolutely soared against the US dollar. From June of 2007, when the yen was 124 to a single US dollar, it absolutely soared to February 2012 when it finally reached 76 to the US dollar. So during the first two Eurodollar crises, the yen was incredibly strong, which is the exact opposite as you may expect, because the dollar is supposed to be strong. And the dollar is strong against everyone else. So during these periods where you have global crisis that does not specifically target Japan, the yen will be stronger against the US dollar. We saw that in Eurodollar number 3, for example. The yen had been falling as carry trading developed in what we call reflation number 2, 2013 into 2014. But by June of 2015, where the yen down 125 to the US dollar, it then strengthened through the rest of Eurodollar number 3, which is a pretty substantial dollar shortage episode, so that by September of 2016, it was all the way up at 100 to the US dollar. And it would stay high over the next several years as we went through repeated Eurodollar funding difficulties and monetary problems, what we call Eurodollar number 4. The yen continued to strengthen because in many ways the Japanese system was reversing some of the carry trade excesses that it had engaged in the early part of the 2010s. But then in 2021, we get to the other side of the pandemic, suddenly the yen plunges during the reflationary supply shock period, simply because Japan at that time, being so dependent upon imports of necessities whose prices were soaring, it was a huge dollar burden on specifically Japan. So the yen weakened dramatically because Japan was in the crosshairs of that specific set of circumstances. But then you fast forward to July of last year, now you've got the carry trade reversing that we've been talking about quite a lot. Now the yen goes higher during the same period when we have global financial difficulties, global monetary difficulties erupting over the period since then. So the carry trade reversed, the yen goes higher. That's a sign of dollar shortage, even though the dollar is going lower against the yen, at least broadly speaking. Talk about the other one, Swiss franc. The Swiss franc has been higher when global risks are rising. And you see that over the last several years as well. Go back to the initial pandemic period and the lockdowns. From March of 2020 to January 2021, the Swiss franc was higher, flight to safety. Very simple to understand. Then reflation. All the way through early 2021 to November 2022, the Swiss franc is again lower. But then November 2022, the forgot how to grow economy, the financial chaos and disruption that showed up in September and October of 2022, the Swiss franc has been going higher since then, but of course not in a straight line. Huge volatility in the franc because a lot of it's tied to the euro, but back and forth, but generally higher over that period of time. And higher as a reflection of risk aversion, risk off tightening in the Eurodollar system. And ever since January of this year, the franc has been rising as well. So just in these three currencies, the euro, the yen, and the franc, that's about 75% of DXY. And those currencies tend to behave contrary to the idea of the dollar going higher during periods of monetary distress. So the euro is volatile during those periods, the Swiss franc is a flight to safety, and the Japanese yen, when Japan is not specifically targeted, ends up behaving more like the franc than not. So you've got dollar problems that tend to be positive for these two currencies and volatile in the third one, which is the majority of DXY. And these differences have become more pronounced since 2017. And there's lots of variation in general. And the reason for this is because these countries, the banking systems in these countries, Japan, Switzerland, and Europe being a region, but the banking system in those areas tends to be dollar redistributors. They're not necessarily dollar borrowers as they borrow in dollars, but they have their local currency as collateral for it. So they're not highly dependent upon the US dollar funding for the operations of the economies in those areas. And unlike emerging markets where they tend to be net borrowers of US dollars rather than redistributors and resuppliers, the effect on local currencies is somewhat different. So when Japanese financial firms decide that they don't want to participate in the carry trade, they're not redistributing dollars anymore. They send the funds back home, strengthening their local currency, while at the same time depriving the Eurodollar system of that redistribution and recirculation. So dollar difficulties erupt, but it tends to be positive for those local currencies where the banking system in those places are dollar redistributors. And we can see these differences in dollar indexes when we look past DXY, starting with comparing a broad trade-weighted dollar index that the Federal Reserve prepares under its H1O data release with DXY itself. And you see exactly what I said. The trade-weighted dollar has tracked higher relative to DXY, but then the forgot how to grow economy, it's there more in the trade-weighted dollar than it is in, say, the euro, because the euro came back so far when it wasn't the worst case, and it proved not to be catastrophic. So you see the tightening in Eurodollar funding and higher US dollar exchange value in currencies outside of those we just mentioned. We see it more in those currencies outside of those we just mentioned. So it's about dollar borrowing access and funding access, not necessarily portfolio flows and relative risks as it is in the advanced foreign economies. For emerging markets, it's all about access to dollars and the funding costs of getting in there. So you really clearly see the divergence and the difference from May to September of last year. The emerging market group, the dollar was up pretty strongly against that group, but against the advanced foreign economy group, the dollar is down because the yen was going higher as the carry trade reversed, and the Swiss franc was experiencing flight to safety. So the dollar wasn't weak during the period when dollar funding conditions were getting worse and worse and worse last year during the carry trade. The dollar was stronger against those currencies and visibly stronger against those currencies. And the same again from the end of last year. The dollar soared from October to January, but with emerging market currencies, it has stayed higher since January, which is consistent with all of the financial chaos, the liquidations and disruptions that we've seen. The dollar is strong against emerging market currencies because emerging market currencies are exclusively borrowers, and therefore it's a reflection of the difficulty in borrowing given the lack of liquidity across the global Eurodollar system. The other currencies that make the dollar look weak, starting with the yen, that's the carry trade reverse, less dollar redistribution. Same thing with the Swiss franc, flight to safety, less dollar recirculation, and even the euro, which just tends to be volatile during these periods. So the dollar isn't behaving inconsistently, and therefore is proof that the dollar is being rejected by the world. It's doing exactly what you would expect it to do given this set of circumstances. It is reflecting funding difficulties and liquidations and illiquidity, lack of circulation in these various different ways, just contrary to what the mainstream says, because the mainstream doesn't know anything about how the plumbing works, what the dollar actually reflects, and really where it's all going and why. Because the Fed did a bunch of QEs that has trillions of bank reserves, therefore we can't have a monetary explanation for why the dollar's doing what it's doing. People have been claiming the dollar's being replaced ever since 2009 when former PBOC Governor Zhou Xiaochuan mentioned it in a speech. Zhou was right that it needed to happen, but everyone has been wrong ever since then, saying that it is happening. It's not, and that's the problem. The other part of this is the treasury market selling. As I keep saying, it pays to pay attention to the plumbing, which is what we do here at Eurodollar University, and it's what we did in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.